So UPS just reported their second quarter, and it's wow. Today's July 28th, 2026, and you're listening to Earnings Unscripted. Here's the wild part. UPS literally spent hundreds of millions of dollars this quarter to strip human labor out of their operations, and they intentionally dumped 2 million Amazon packages a day out of their network. But somehow, top line still went up.
Right. They're basically shrinking their volume to force better margins. I mean, they pulled in $22.8 billion in revenue, growing nicely year over year. So the surface picture looks solid. But if you look under the hood, the bottom line's incredibly messy. Adjusted EPS landed at $1.76, but their GAAP earnings got absolutely crushed by those structural changes.
Yeah, and Wall Street really didn't care for the messy parts. I was watching the tape and the stock gapped up hard pre-market, but then reversed fast and just fell off a cliff once the call started.
Exactly. It finished the regular session down about 6%. And since we're tossing opinions at a pretty steep sell-off here, just remember, our analysis isn't financial advice, purely our own read on the tape. But, the market saw the price tag on that restructuring and bolted. They took an $891 million write-down, almost entirely tied to what they're calling the Driver Choice Program.
Which sounds like such a polite corporate name for paying people to leave so you can replace them with AI and sensors. For a company whose entire brand relies on a person in a brown shirt carrying a box up your driveway, that's a massive identity shift.
Absolutely. And they're absorbing all the severance cash pain right now so they can run a highly automated, leaner network tomorrow. It's the same story internationally. Geopolitics in the Middle East forced them to completely reroute flights, jacking up fuel and lease costs. The whole quarter's just them eating heavy structural hits to protect future leverage.
Which brings us right back to that huge labor write-down. I need to understand how ripping out barcode scanners to build an RFID sensing network actually justifies blowing a crater in their cash flow this quarter.
It's all about trading short-term cash for permanent margin expansion. They basically swapped physical human labor for hardware. Carol Tomei had this great quote on the call where she said, think of RFID as the eyes and ears within our network and AI as the brain.
Wait, so by RFID sensing, are they just talking about slapping smart tags on boxes? Because don't they already scan everything a million times anyway? What's the actual difference here?
The difference is it's manual versus ambient. Right now, a human physically picks up a package and shoots it with the barcode scanner. Doing that across millions of packages takes an insane amount of time. What they've done is outfit their stores, facilities, and package cars to just sense the box as it walks by. They noted this eliminates hundreds of millions of manual scans every single year.
Okay, wow. So if the truck just automatically knows what's inside it, you don't need a guy standing at the back door with a laser gun?
Exactly. And the labor impact's just staggering. Brian Dykes, the CFO, mentioned they've eliminated nearly 78,000 operational positions, plus about 50 million labor hours over the last couple of years.
Jeez. So that's what that huge driver choice program write-down we mentioned earlier was actually paying for? Just buying out the workforce?
Pretty much. They funded separation payments for about 80% of departing participants right here in the second quarter. That's why proxy-free cash flow just got crushed. It dropped to roughly $293 million.
So they took the pain up front, but wait, if they're shedding all these jobs, how are they handling the volume? Doesn't the network just buckle, or is this where firing Amazon comes in?
Right. That's the other half of the equation. You shrink the capacity, so you've got to shrink the low-margin volume to match. They called it the Amazon glide down.
The glide down? It sounds so gentle, like we're respectfully declining to deliver your cheap boxes.
Exactly. But honestly, it's brilliant. They shed that massive chunk of daily Amazon volume we flagged earlier. So Amazon's now just 9% of total revenue, down from a pandemic peak over 13%.
Okay, so they dumped the filler volume, bought out the excess labor, and replaced the manual scanners with ambient sensors. That's an entire margin harvesting operation, which actually explains how their adjusted operating profit jumped so much sequentially.
Yeah, non-GAAP adjusted operating profit popped to around $2.1 billion. They're explicitly targeting a wider spread between revenue per piece and cost per piece for the back half of the year. Oh, And here's a wild anecdote to show why this sensing network actually matters for pricing power.
Okay, let's hear it.
So, they poached a high-end jewelry client from a competitor. With the old carrier, this jeweler literally had to hire physical security guards to watch human workers scan their packages individually onto trucks to prevent theft. But because UPS uses this ambient RFID setup, the packages just roll onto the truck and get logged automatically. Zero manual touches, so the guards aren't needed anymore.
Oh, wow. So they aren't just cutting their own labor costs, they're cutting their clients' labor costs too.
It's a massive structural moat. You can't just fake that with a software update. Same story with their healthcare supply chain. They can move fragile biologics from Belgium to a freezer in Kentucky in under 24 hours because it never leaves their proprietary temperature sensing network. No third parties.
That level of physical control's incredible. But, it raises a massive red flag for me. If they're running this hyper-lean network right now and they've just gutted the workforce, what happens when their volume predictably surges for the holiday?
That's exactly the gamble. They expect domestic volume to lift about 24% sequentially into the holiday season, but their whole argument is that the new automated network can absorb it without massive temp hiring, so you finally get real operating leverage.
So they're betting the sensors don't get tired in December. It makes a lot of sense, but I totally get why investors are jittery about the execution. There's zero room for error if the technology glitches.
True, but management's clearly convinced the worst is over. They actually raised their full-year view across the board, guiding to roughly $91.2 billion in revenue for the year. Plus, they're seeing momentum return on the China to U.S. trade line, which helps offset some of those ongoing international headaches.
Right, especially since they're still having to actively dodge airspace in the Middle East. If they really just reset their baseline margins permanently and those brutal cash hits are finished, it completely shifts how you have to view their trajectory going forward.
Exactly. The CFO didn't mince words on the call either. He said the successful completion of the Amazon glide down and related network reconfiguration marks an important inflection point for UPS. They're putting a stake in the ground right here.
Well, if it works, it's a phenomenal corporate pivot, firing your biggest bulk client and buying out your own workforce just to build an incredibly efficient machine. We'll definitely see if the holiday rush proves them right.
Always a pleasure. Catch you next time.
If you enjoyed pulling apart these corporate filings with us, just hit follow on your podcast app so the next episode pops right into your feed.
And in the spirit of UPS swapping physical labor for automation, I should mention that this whole podcast's actually an AI experiment, meaning the two of us are completely synthetic voices going from the earnings call to your speakers on the exact same day. We'd really love to hear your ticker requests, so drop us a quick note at earningsunscripted.datamadness.ca. See you next time.